All right. Hi, everyone. We are live. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by CNBC's senior stocks correspondent, Bob Pisani. And today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. How you been?
I've been good. Yeah. How are things at the stock exchange going?
People are coming back. I went away for a month, mid-December, came back mid-January, and it was empty in the financial district. Wall Street was just empty. And in the last few weeks, it's really come back. There's a lot more people around. The delis are fuller. That's one way you can tell people are around how busy. So it's reopening. 2022 is still going to be the year of hybrid. A lot of people don't want to go back to work. They're perfectly happy. If you force them, they'll go back for 2 days, but it's going to be rough getting a lot of people. But knowledge workers are very comfortable, working at home. And I think there's a significant group that might be, 50% that want to go back 2 days a week. But I don't think there's 100% want to do anything. I think a very large number of people would be very happy to do a little bit of hybrid. And that's what you're going to see happening.
Yeah, definitely. Well, I'm happy to hear that some people are starting to come back. So that's good to see. So let's get started. You've said this week that the stock market is acting like the economy is in a late stage cycle. What does that mean?
Well, it's important to understand that the U.S. economy and all economies go through cycles. 100 years ago, they were called boom and bust cycles. It's a little smoother than that now, thanks to efforts by the Federal Reserve, which is one of the reasons the Federal Reserve was literally created, was to smooth out the boom-bust cycle. Things used to be pretty crazy in the 19th century. You had these bank failures that happened all the time, and runs on the money and people runs on the bank. And the Federal Reserve was created to deal with that, really, in 1913. But it's still fair to say that the economy goes through cycles. And so there's a early stage, middle stage, late stage cycle, and then there's usually a recessionary period. So what I meant by this when I said the market was acting like it's in a late stage cycle, that late stage is the last stage before a recession. So what you usually see in these situations is wages go up, inflation goes up, you get decelerating economic growth. You still get economic growth, but it's decelerating, and you get a profit peak and margin peak. This is almost exactly what we're starting to see right now. And the thing that makes me a little concerned is the market's acting like we're already in the late stage cycle. Why is that? Because, well, the way they're buying and selling stocks indicates that. So in a late stage cycle, cyclicals tend to fade away. Cyclicals are stocks that do better when the economy is expanding and contract when the economy slows down or contracts. So we've been noting all week transportation stocks were at new lows. That is the classic cyclical. Home builders were at new lows. Industrials have been fading, not new lows, but fading a little bit. At the same time, what's been doing better? What's holding up? Interest rate sensitive stocks, commodity stocks, interest rate sensitive like utilities and REITs, commodity stocks like energy and metals, and defensive stocks, consumer staples and healthcare. Again, classic late cycle. Investors tend to go to stuff that is a little bit on the boring side, but has a steady stream of earnings, or in the case of, say, utilities, steady stream of dividends. So that's why I'm saying that the market's acting like we're in a late stage of the economy. This is fine, and this is one of the reasons the S&P is only down about 4% for the year. But defensive stocks like consumer staples and commodities, if you put them all together, they're only about 30% of the market. The very large part of the market, frankly, is consumer discretionary technology and communication services. And, that's 60, 70% of the market there. And so it's very hard. They don't balance each other off, with technology kind of fluttering. Semiconductors have not had a good time. In fact, if you look at the SMH, that is the semiconductor ETF, it's a basket of the big semiconductors. That's not that far from a 52-week low. So, one of the things you have to do when you're a stock market observer is you have to see what is going on, and then you have to see what the facts are. and then you have to describe what scenario, what narrative accounts for the facts. And when I look at this, and I've been stocks correspondent for 25 years, what it sees to me is that this is late cycle behavior for the stock market. It's acting like it's in a late cycle. So that's why I've been insisting on this. And by the way, it's very important that you look at the facts and then figure out, well, what is the narrative that would explain these facts? You don't do the opposite. I see people doing the opposite. I see people that have an ideology in their head and they want to impose it on the stock market. I call this yelling at the stock market. Don't yell at the stock market. This is one of Pisani's laws of broadcast journalism. Don't yell at the stock market. Don't say, oh, the market doesn't get it. I'm the lone genius that understands it, and I'm going to explain it to the world, and hopefully the market will come around to my point of view, and then I'll say, aha. Don't do that. You are not the lone genius out there that is going to explain the universe. Don't succumb to that, silliness. Look at the market and figure out what it's trying to tell you is the way to go at it. So that's what I mean when I say I'm talking about late stage.
So, Bob, we got a lot of questions about, are we heading to a recession? And if so, how should investors prepare?
Well, the thing that's concerning me is the market's sort of acting like we're going to be going into a recession 6 to 9 months from now. That seems a little implausible to me. I guess, in an era where you go through cycles really fast, faster than 20 years ago, that's for sure. Maybe we could. And, if this is a late stage, you can have late stages. You can go on for a year. Most people aren't saying we're going to go into a recession later this year. They're saying, well, sometime in 2023 or 2024. They don't know. Nobody has a clue. But the market's kind of acting like we're going to, go into one. This is why what the Fed is doing is very, very delicate right now, because the great killer of bull markets traditionally has been the Federal Reserve aggressively raising interest rates and killing recoveries or inducing essentially recessions. There's a long history of this happening, and they usually do it in response to problems like inflation. So in a sense, the way you deal with inflation is you kill demand. You have demand destruction, and that stops people from doing things. So are we headed toward a recession? Right now it sure doesn't look that way, but remember, the market is a discounting mechanism. The game of the market is to front run everybody. So, and a reasonable time frame to think about how the market looks is about 6 to 9 months out. Frankly, beyond that, nobody has a clue. If you think you can predict where things are going, a year or 2 years out, God bless you. But your track record, I guarantee you, is going to be bad as everybody else. By the way, the Federal Reserve, which you think would know a hell of a lot more than everybody else, they have a terrible track record of predicting the economy going out more than about a year. The future is very difficult to figure out. It's almost unknowable because there's such a multitude of factors that go into dealing with something like the global economy. So don't get too arrogant. That's my point to you, all of you. Reasonable estimates can be made 6, 7, 8, 9 months out. Beyond that, you're really stretching. So I would say there are people out there who are trying to prepare for a recession and acting like the economy is going to do it. And that's why I see this behavior in the stock market. I'm not as personally as pessimistic as those people are.
So, Bob, you brought up the Fed and inflation. We heard some more aggressive commentary from the Fed this week. So what does that mean for the markets? And then,
well, I'll tell you, we had Mester and aggressive comments. And I'll tell you the thing that alarmed me the most was Bill Dudley. Bill Dudley was the former federal governor of New York, very influential guy. And he came out with an editorial in Bloomberg. And let me read you what a relative phrase line here is. Financial conditions, this is Bill Dudley. He's not with the Fed anymore, but he's influential. Financial conditions need to tighten. If this doesn't happen on its own, the Fed will have to shock the market to achieve the desired response. This would mean hiking the federal funds rate considerably higher than currently anticipated. One way or another, to get inflation under control, the Fed will need to push bond yields higher and stock prices down. And he made a specific point of saying, okay, I know you think the market's down, but we're only down 4%. for the year. And he's right. That's the S&P 500. His implication is the Fed's going to have to get very aggressive. And if it doesn't work, one way you get demand destruction is lowering the stock market. That's a comment right there. So, you and I have been talking about off camera about inflation and where it is. I went to Key West and Miami Beach and Phoenix in the last 6 weeks. I've been traveling a little bit again for the first time in a couple of years. I'm going back to Miami Beach for the ETF conference next week, and these prices are amazing. I had complained about it. Hotel prices are just about double what they were 4 years ago. And you can look at that and say, well, demand's really high, and it's true. They're full, these hotels. The airline prices forget bargains. They're gone. Any bargains in January are long gone. Well, how do you stop that? Well, you have demand destruction. And the way the Federal Reserve does it is they raise interest rates that has an effect of like raising mortgage rates. Indirectly, it does, not directly, but indirectly, even though the Fed only controls short-term rates. And it generally lowers prices in the stock market, and that creates a wealth effect. You feel less wealthy. So that's what Dudley was talking about here. How can we want, Dudley said, this is kind of remarkable, we would like to see lower stock prices because it'll make people feel less wealthy and will help lower inflation. That's the implication of what he said. Now think about that. That's a Federal Reserve guy, I'm former Federal Reserve guy, but very influential. I don't know. He's basically saying, unless things go down, we're just going to keep hiking rates higher and higher. They want to see inflation come down, and to get inflation down, you need demand destruction. And demand destruction means less wealth effect, lower stock prices, at least in the short term, lower hotel prices, lower airline prices, go down the line. So I think Dudley's the most important comment this week.
Yeah, it'll definitely be interesting leading up to the next Fed meeting to see, what the commentary is on that and what ends up happening. So definitely something we'll be keeping an eye on. But our next question is switching topics here about Elon Musk. He took a 9.2% stake in Twitter, and he also now has a board seat. So what does that mean for the company?
I don't know how I feel about this. So I give you on the one hand, on the other hand. On the one hand, I've said this for years. I think Elon Musk is one of the great geniuses of the 21st century. I think he is the Edison of his day. Very few people can ever say, I'm going to influence the space program. I'm going to influence the electric vehicle market. I'm going to influence the solar market and the battery market and actually pull it off, which he has done. So, I give him very wide berth because he's done amazing things. On the other hand, the more power he gets, the more he seems willing to take on virtually anything and anyone, including the President of the United States, the SEC, anybody. Now, that makes me a little cautious about him. So on Twitter, people really disappointed in Twitter. It went public, 8 years ago or 9 years ago? I think it was 2013. And I think the first day it was trading at $45. Do you know where it is today? It's like $43. 9 years later, it's still essentially where it was on the first day. And the only reason it's 43 is because it's probably up 15% since Musk made the comment that he had that 9% stake in there. But look at this. He makes a 9% stake and says, oh, it's a passive investment. Then he turns around and says, oh, wait a minute. Sorry about that. It wasn't passive because I have a board seat. So that filing that he made, which is a legal filing, was erroneous, essentially. It seems to me erroneous. I mean, the guy just changed his mind the next day. Doesn't that make you pause a little bit about what the intentions are here? Now, yes, there's this talk about, oh, we need an edit button. Now, conceptually, that's not a bad idea. Everybody types something in on Twitter every once in a while, and they make a typographical error, and then you have to delete the whole damn thing, and it's a pain. So if you had an edit button, yes, I'm not against an edit button. Fine. But I'm sorry. What is the purpose of this? Is the purpose really because, oh, I want to improve democracy around Twitter? Or am I just want to use this as a blunt instrument for myself in some way? I don't know the answer to that. I'm just raising the question. Remember, just be like the stock market. Don't tell the stock market what to do. Just watch the behavior of the stock market and say, what would account for this behavior? So watch Elon Musk and then say to yourself, what would account for this kind of behavior? And that's all I'm saying. I'll stop there.
Yeah, I think an edit button could definitely be very useful in a lot of cases for people. So switching topics here again, Bob, this month, April, is Financial Literacy Month. I was wondering if you could talk about some resources that might be useful for people if they're interested in learning more about financial topics.
Yeah, so there's Sharon Epperson, my colleague, did a great story this week about how parents need to talk to their kids more about financial literacy. And interestingly, the survey that Sharon did revealed that parents would rather have the conversation with their kids than learn it in school, because people have been pushing for years to have one course in high school to teach financial literacy. What's a bond? What's a stock? What's the Federal Reserve? You know, I never had one of those. I graduated not even knowing when I was 18. And there's a lot of people, they don't even know how to write a checkbook. So I'm in favor of particularly a single course in high school. But Sharon noted that people would rather have a conversation with the kids and teach it in the class. And yet the parents don't know anything themselves. They're terrible about financial literacy in this country is terrible. That's why people make stupid decisions all the time. So we need financial literacy for the parents, not for the parents to talk to the kids, because they don't know enough to tell their kids. All right, some parents do, but you know what I'm talking about. It's pretty bad. So if you want a site to go to, if you only wanted one site, believe it or not, the government has a great site. It's called investor.gov, and it's run by the SEC, investor.gov. So you can go on here and, for example, suppose you got a financial advisor. You could look up your financial advisor and see, you know, if there's been any complaints about them or things like that. You can get information on crypto stuff. You can get information. There's calculators on it. So, like a mortgage calculator or compound interest calculator. If you want to figure out, you know, you got $1,000 and it grows 5% a year for 10 years. How much do you have after 10 years? There's calculators. It's really cool. There's a section on understanding fees, which people don't understand. People get ripped off all the time on fees because partly they don't understand them. They don't bother to look, but there's a whole section on that. So there's a lot of great websites that the e-brokers maintain too. But if there was just one, I would go to investor.gov and just play around with it, look it over. It's really interesting. They spend a lot of time keeping it together at the SEC. And I'm pretty impressed. And you can sign up for like updates, you know, if they put out some warning about something, if you're really into that kind of stuff. I have to, because I partly cover what the SEC has to say. So I look at it and I get the updates. But check it out, investor.gov.
Yeah, I think that's really great advice, Bob. And like you were saying, financial literacy isn't just for kids, it's for everyone. So it's definitely an important topic to discuss. Our last question, Bob, there was a tweet from Lizanne Saunders that hedge funds posted their worst quarterly performance in Q1 22 since Q1 20. What does that mean for investors?
Well, for most investors, it doesn't mean a lot. The hedge fund industry is pretty small. After, 20 years of covering this, I'd say they're probably $3 trillion. That's pretty small. I mean, the S&P 500 has a value of $40 trillion. So it's not a big, but they're influential as thought leaders, some of them. Most hedge fund managers never talk to the press, 99% of them. But there are a few, a small number, that do and are influential thought leaders. It may have been the worst quarter, but my understanding is they were only down about 1 or 1.5%, somewhere around there. That's not too bad. Here's the problem I have. There have been many, many studies that active management does not outperform. Many, many studies. Now think about this. A lot of these hedge funds charge 2% and 20% of anything that they make. Think about what you have to do to outperform on that. So if the S&P is down 4%, they're still charging you 2% to do that. you know, I mean, on top of it to get, if the S&P is up 4%, and let me just switch it around, and they're charging you 2%, I mean, just imagine this. You know, this is a lot of outperformance you got to do to make up for that. And most hedge funds don't. Most professional investors don't either. Every year, I spend a lot of time on this. S&P, Standard & Poor's, does a big study of all active mutual funds. We're talking thousands of people, funds. And every single year, it's called the SPIVA study. You can go in, just Google SPIVA, S-P-I-V-A, SPIVA Standard & Poor's. And they do one for different parts of the world, but you want the US study. It just came out. I did a whole thing on it. Once again, you know, the numbers are terrible, particularly when you look over long periods of time. And what they saw is you want to look at it like a 10-year period, 85, 87%, I think, actually, of fund managers underperform their benchmark. Think about this. 87% underperformed their benchmark. So if your benchmark is the S&P 500 and you're trying to outperform the S&P 500, after 10 years, 87% of fund managers don't do this. Now, here's a couple reasons why. Number one, the fees are too high. So even the small percentage that actually generate alpha, outperformance, because they charge a fee, you might charge 1%, 2%, that fee eats into the total return. And so they don't outperform. That's one reason. The other reason is you get what's called survivorship bias. A lot of funds, in fact, you know, more than 50% of funds go out of business in less than 10 years. Why did they go out of business? They closed them. Because they're terrible. Because they don't outperform. Because people lose money and they keep withdrawing money from the funds. They're terrible. That's why. So S&P looks at what they call survivorship bias. A lot of these, you know, funds that cite their outperformance, they only cite it against funds that survive. You don't do that. If you're losing money in a fund and it closes, that's a pretty real loss to you. So you have to account for what is called survivorship bias. And when you do account for that, for all the poor slobs that are in these funds that lose money, that eventually, you know, close, the numbers are terrible. You might want to ask why. I'll tell you, I told you earlier, the real reason is the future is unknowable. It is very, very difficult to figure out where things are going. Market timing doesn't work because you have to be right going in and you have to be right going out. And the probability you're going to be wrong on one of those ins and outs is very, very high, particularly if you do it on a regular basis. So there's an old joke in the market, you know, there's 10 days in the market that are the most important. If you're not in on those 10 days, your returns are going to be terrible compared to a benchmark. But nobody knows what those 10 days are. Literally nobody knows. That's the argument for the stay long and stay in crowd. And just understand what your risk tolerance is. If you can't stand the stock market, it makes you nervous, but don't have a lot of money in the stock market. If you're 30 years old, why would it matter? It's not going to matter. You're going to live to 100. But some people have higher risk tolerances. So my point is of this discussion is I wouldn't worry so much about what you think some hot hedge fund manager is saying about the world. I wouldn't worry about it that much. I try to figure out what your risk tolerance is. How old are you? How long are you going to live? And then say, okay, I'm comfortable having 75% in stocks, 20% in bonds, 5% in cash, or 5% in REITs or real estate or whatever you're comfortable with. You have to figure that out and recognize if you're 30 years old, it's not going to matter what happens this year. Believe me, it's not. You're not, even if it's year 2000 and the market dropped, or 2008 and the market dropped a lot. 2008 in the long run did not matter for the overall long-term trend of the market. It was a big thing then, but you have to be able to sit through that and weather that. You have to understand what your own risk tolerance is. That's the most important thing, not figuring out if you can buy and sell Twitter in 2 days. Trust me, you think you're going to make money and you said, oh, gee, I just made $5,000 trading Twitter. This is great. I'm a genius. You're not. Try doing it every day for 30 years, every day. And the academic literature is overwhelming when subjected to rigorous controls, including the costs of buying and selling, the tax consequences of buying and selling, actively trading and trying to time the market does not work. You're probably going to lose money. That's why buy and hold, understanding risk tolerance, it's a little boring, but long term. Talk to anybody who comes on our air, any financial advisor, that's what they'll tell you. So I know I say that almost every time, but you got to keep repeating this for people who don't seem to understand that they're not geniuses because they just made some money trading GameStop or Twitter.
Yeah, and I think having that longer term perspective is really helpful for people. So thanks for sharing that, Bob. But yeah, that's all of our questions for today. Have a great trip to Miami. Definitely report back to us on the prices that you're seeing down there.
I'll be at the ETF conference Monday and Tuesday. I'll be talking to Kathy Wood, by the way. Talk about a interesting woman to talk to. Will be on our air with me 4 o'clock Tuesday afternoon. So tune in and you'll see some very interesting things. Some big money managers. Jeff Gunlock will be there too. See if I can get him on the air.
Yeah, that'll definitely be very interesting to hear. So thanks everyone for sending in your questions as always, and we'll see you again in a couple of weeks.
Thank you. Thanks, Katie. Thanks, everybody.